Oh, hi. I was just counting money because that is exactly what we are going to talk about today. Not just about money, but the entire banking system. Now, I'll try to make it as easy as possible for you to understand how your money is saved in the bank, how you can withdraw money, the different types of accounts there are, and which one will be best for you. And if you have not already subscribed to this channel, do that and let's learn about Introduction to Banking.
Introduction to banking. First, let's understand what is a bank. Bank is a financial institution that accepts deposit with a promise of offering interest rate to the public. And secondly, it also lends money by charging interest from them. All right? So that is what a bank is. Now let's learn about how does the bank function. So basically, what are the functions of the bank? First, accepting deposits. Now, it accepts deposits by offering different types of accounts. One is a demand deposits and the second is a time deposits. Now, as we move ahead in this video, you will understand pretty well what a demand deposit is and what a time deposit is. Okay? The second function of a bank is advancing loans. Now, bank offers loans depending on the needs of the firms or individual. Okay, so there are different types of loans. One you have short term, one you have medium term loan, and one you have long term loan. Now, this is all depending on the time factor. So basically, right now, what I want you to remember is accepting deposits and advancing loans are two basic functions of a bank. Let's move further. Types of accounts. First, we have saving banks account, current bank account, recurring deposits account, and fixed deposits accounts. Okay, so first, saving banks account. It is for regular operations or for a day-to-day usage or for a salaried account, and interest is paid per annum. So you get certain amount of interest from the bank for the amount that you have kept with the bank. Okay, and this part is a demand deposit. So basically you can withdraw anytime that you need money. So what happens here is whenever you want money, you can go and withdraw your money. There is no time factor which comes into play with regards to the saving banks account. Second one is a current account. Now this is offered basically to the businessman, and there is no restriction on transaction. You can do as many transactions as possible, no issues. The key factor is there is no interest paid by the bank to the customer. That's why it's called as non-interest deposit. This also falls into the category of demand deposits. So basically a businessman can just do as many transactions as possible. There is absolutely no restrictions on that as far as there is money in the account. The third type of account is recurring deposits account. So it's called as RD. Now, it is offered to those who regularly deposits into accounts at a regular interval, like for example, monthly, yearly, and so on. Okay. The positive thing about this is that it gives you higher rate of interest than your saving banks account. Okay. So it's profitable in that way. It is called time deposit account because you're not allowed to withdraw the money until the maturity of that particular amount. To suppose you go and form an RD today, you just cannot remove your RD tomorrow. Okay, so the maturity period ranges from 6 months to 10 years. Okay, so minimum at least you need to keep for 6 months and then you can withdraw your money. The fourth type of account is fixed deposit account, what you popularly called as FD. A lump sum money is deposited for a fixed period of time. Like for example, say you have say 20,000 rupees with you and you want to put it in a fixed deposit account. So you put the entire 20,000 at once in the fixed deposit account. Now you can withdraw this from 7 days to 10 years. Okay, between that you can withdraw anytime. In fact, you can renew the maturity period of the fixed deposit account. Again, a positive thing about this account is that it has a higher rate of interest. And since the time factor comes into play with fixed deposit account, it's called as time deposit. Let's move forward. Financial instruments. So you have a checkbook, pay-in slip book, debit card, credit card, fixed deposit receipt.
Financial instruments. Any instrument which is used to do financial transaction is called as financial instruments. Now I'll give you an example of it. Now take for example a checkbook. Okay, this is a checkbook. This is what the checkbook looks like. So basically what happens is, suppose you need to pay say 10,000 rupees to somebody else. All you need to do is, from your checkbook, you need to write the name of that concerned person, write the amount and give it to that person. Now that person goes to the bank and gives this check, and bank in turns gives money from your account to that concerned person. So that is how the checkbooks in simple works. Second, this is what the pay-in slip looks like. What's the use of this? Take for instance, you have 10,000 rupees in your hand and you need to deposit it in the bank. All you need to do is fill in the details about the amount that you're going to deposit and the account number of yours, and it will be deposited in your account. Suppose you need to withdraw say 2,000 or 3,000 from your bank account. You can use something called as cash withdrawal slip. All you have to do is just fill in the details with your account number and how much you need to withdraw, and bank will give it to you as long as you have money in your account. All right. Third part of the financial instrument is a debit card, and this is what a debit card looks like. And I don't have to go too much in detail of it because I'm sure most of you are very familiar with a debit card. What can you do with a debit card? You can withdraw cash from an ATM, and also you can use it for shopping. Fourth part of the financial instrument is a credit card. Now I don't have a credit card, but a credit card looks very similar to this again. But the way it functions is slightly different. Now I'm not going to define what a credit card is, but I'll give you an example so that you understand how a credit card works. Okay? Let's say for instance, you decide to buy a refrigerator worth 40,000 rupees. Now using your credit card, you can pay from it, but a bank at that time will be paying for you. And at the end of the month, you can pay back to the bank. All right. So this is the easiest way I could explain to you how the credit card functions. Now, of course, remember, bank is not a charitable institution. They will charge you certain amount of interest on your transaction. Okay. So bank is a business and they will make sure that they also get a profit from it. So that is how the credit card works. Fifth part of the financial instrument is fixed deposit receipt. Now, basically it just looks like a certificate stating the amount you have invested or put in your fixed deposit account. Now, the two advantages of it is, one, that it gives you higher rate of interest of the money that you have invested, and second is you can use it as collateral. Now I know the next question which is popping in your head is, what is collateral? So I will not define what is collateral to you. I'll give you an example so that you understand it. Take for instance, you decide to buy land and you go to a bank asking for some loan. Now bank is not going to be saying, okay, whatever amount you want, you take it. Now bank is going to say, keep some collateral. Okay, that means keep some security with us so that we can give you that whatever amount of loan you want. So you can use that receipt as a security to keep it with the bank as a collateral. Okay, so these are basically 5 instruments. One is a checkbook. One is the pay-in slips. Third one is a debit card. Fourth one is a credit card. And the fifth one is a fixed deposit receipt. Let's see further.
Types of banks. Let's look at the types of banks. So you have a commercial bank, central bank, and cooperative bank. The functioning of the commercial bank is accepting deposits and lending loans. Okay, so basically it accepts money and gives you money, of course, with the interest. There are 3 types of banks when it comes to commercial bank. One is public sector bank, private sector banks, and foreign banks. The second type of bank is the central bank. This is the most important bank in India, which is called as the RBI, the Reserve Bank of India. And what are its functions? It issues currency, basically looks after the functioning of the commercial banks. Third, it is also called as a government's banker. Why? Because the government can take loan from the RBI. It looks after the money supply and it also regulates the interest rates of different banks in India. So basically looks after everything with regards to the bank. So you can say it is a BAP of all the banks. Okay, so central bank, that's the RBI. And the third type of bank is the cooperative bank. Now it is owned and run by the customers themselves. It accepts deposits and also grants loan to the members and non-members. So these are the 3 types of banks. And finally, let's look at the new technology that is developed in the banking system. The first one is IMPS. So what's the full form of it? It's immediate payment service. This is all part of the internet banking system. So you can use it from your phone as long as you have internet. You can use it on your laptop as long as you are registered with the bank for internet banking services. You can use this 24/7. Now with the IMPS, the minimum transaction you can do is for 1 rupee to maximum of 2 lakh rupees. Okay, I repeat that again. Minimum 1 rupee to maximum 2 lakh rupees. Second technology is RTGS. That is real-time gross settlement. Basically, so what happens here is when you're transferring money from one account to the other, it happens on a real time. So it happens very quickly. And a minimum transfer is 2 lakh rupees. Remember, IMPS minimum is 1 rupee to maximum of 2 lakh rupees. Here the minimum transfer is 2 lakh rupees and it goes on. This is used mainly by the companies to send large amount of money. NEFT, National Electronic Fund Transfer. It is a system where you can go and approach a bank and authorize them to transfer fund from his or her account. Okay, here there are certain restrictions. So what I mean by restriction? So there are 12 settlement cycles during the weekdays and on Saturdays there are 6 settlements. The amount which you are going to transfer happens within 2 hours. There is no minimum or maximum limit when it comes to NEFT. Let's move forward. With internet banking, it's almost like you are carrying a bank with you all the time. You can use internet banking from your phone or your laptop as long as you have internet and your internet banking services are registered in the bank. Bank will give you a username and a password and you can transfer money. You can check how much money you have in your account, so balance inquiries, and also through internet banking you can make payments. Let's move forward. Mobile banking. It's basically performing banking activities through your mobile phones. You get your OTPs there, that is a one time password. When you withdraw a large amount of cash from an ATM, OTP is required. And for other transactions also, you require an OTP. So that is part of the mobile banking services. A customer has to be registered with the bank. The phone number of the customer has to be registered in the bank. And to do the transaction, all you require is a network. That's it. The last part is ATM, automated teller machine. I'm sure every one of you have seen an ATM. So you can check balance, you can withdraw cash, etc.
So that's it for today. Don't forget to share this video with as many people as possible because everyone should understand money before they spend money. See you next time. Take care. Thank you very much.